Hello traders, welcome back to the ComLucro channel. Today, we are continuing our technical analysis for day traders course by exploring reversal chart patterns and how they can help identify potential changes in market direction. These patterns can reveal when an existing trend is losing momentum and may be preparing to reverse. By learning how to recognize the structure and wait for proper confirmation, traders can identify more valuable opportunities and make better informed decisions. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Now, let us begin by answering the main question. What are reversal chart patterns? Reversal chart patterns are formations that develop on a price chart and indicate a potential change in the direction of the current trend. They can be especially useful for day traders because identifying a possible reversal can reveal opportunities in both bullish and bearish market conditions. A bearish reversal may develop after an uptrend, while a bullish reversal may form after a downtrend. The primary purpose of a reversal pattern is to show that the current trend may be losing strength. It reflects a gradual change in the balance between buyers and sellers, suggesting that the side controlling the market may no longer have enough strength to continue pushing price in the same direction. By recognizing these formations, traders can better evaluate when to enter a new position, when to exit an existing position, or when to avoid trading until the market provides clearer confirmation. However, a reversal pattern should not be treated as confirmation by itself. The formation only reveals a possibility, so traders still need to wait for price to break an important structural level before assuming that the reversal is valid. Now that we understand what reversal chart patterns are, let us examine how they work. At their core, these patterns represent a shift in market sentiment. They show how the interaction between buyers and sellers begins to change as the current trend loses momentum. During an uptrend, buyers are normally in control and continue pushing price higher. When a bearish reversal pattern begins to form, it suggests that buyers may be losing strength, while sellers are becoming more active. During a downtrend, sellers are normally in control and continue pushing price lower. When a bullish reversal pattern develops, it may indicate that selling pressure is weakening and that buyers are beginning to regain control. With that foundation in place, let us begin with one of the most well-known reversal formations, the head and shoulders pattern. The head and shoulders pattern usually forms near the top of an uptrend. It suggests that bullish momentum is weakening and that the market may be preparing to reverse into a downtrend. This formation is visually distinctive because it consists of three peaks. The first peak forms the left shoulder, the middle and highest peak forms the head, and the third peak forms the right shoulder. The left and right shoulders are generally lower than the head. They do not need to be perfectly equal, but they should create a recognizable structure around the higher central peak. To understand this more clearly, let us look at how the formation develops. Imagine that the market is moving through a steady uptrend, with buyers consistently pushing price higher. Price first rises and forms a peak, creating the left shoulder. It then pulls back as sellers temporarily push the market lower. Buyers return and produce another rally, this time moving price above the previous high and forming the head, which becomes the highest point of the structure. After reaching that higher point, price pulls back again. Buyers then attempt another rally, but they are unable to push price as high as they did before. This weaker rally creates the right shoulder, which remains below the head. The inability to produce another higher high suggests that buying pressure is beginning to weaken. Now, let us break down how to identify this pattern more clearly. To recognize a head and shoulders formation, look for three distinct peaks. The first and third peaks form the shoulders, while the larger peak between them forms the head. However, the pattern is not confirmed simply because those three peaks are visible. Confirmation occurs only when price breaks below the neckline. The neckline is a support line drawn beneath the lows that form between the left shoulder, the head, and the right shoulder. Depending on the structure, it may be horizontal, slightly ascending, or slightly descending. This level separates a developing formation from a confirmed reversal. As long as price remains above the neckline, the bullish structure has not yet been broken. Once price closes below it, sellers demonstrate greater control, increasing the probability of a bearish reversal. Now, observe the Bitcoin against the US dollar chart. The market begins in an uptrend and gradually forms a head and shoulders structure. First, price creates the left shoulder before pulling back. Buyers then return and push price to a higher high, forming the head. After another pullback, they attempt one final rally, but fail to reach the previous high, creating the lower right shoulder. At this point, the visual formation is complete, but the reversal is still not confirmed. The key moment comes when price breaks below the neckline. Once that happens, the head and shoulders pattern is confirmed, indicating that sellers may have taken control and that a bearish reversal could follow. Now let us look at the inverse head and shoulders pattern, which works in the opposite direction. This formation usually develops near the bottom of a downtrend and suggests that bearish momentum may be weakening. As the structure develops, sellers gradually lose control, while buyers begin stepping into the market. Like the standard head and shoulders, this pattern consists of 3 turning points. However, instead of 3 peaks, it forms 3 troughs. The first trough creates the left shoulder, the middle and deepest trough forms the head, and the final trough creates the right shoulder. Although the shoulders do not need to be perfectly equal, the overall structure should clearly show a lower central trough surrounded by 2 higher ones. The pattern remains incomplete until price breaks above the neckline, which is drawn across the highs between the 3 troughs. As long as price remains below this resistance level, the bearish structure has not yet been broken. Once price closes above the neckline, buyers demonstrate greater strength, increasing the probability of a bullish reversal. An important rule when trading either version of the head and shoulders pattern is to wait for a clear neckline break before entering. Some traders enter immediately after the breakout, while others prefer to wait for a retest of the neckline as new support or resistance. Although a retest can provide additional confirmation, it does not always occur, so waiting for one may also result in missing valid opportunities. The stop loss should always be based on market structure, rather than emotion. In a bearish head and shoulders setup, it is commonly placed above the right shoulder, or another logical invalidation level. In a bullish inverse head and shoulders setup, it is usually placed below the right shoulder, or beneath the level that would invalidate the reversal. Profit targets can be estimated by measuring the distance between the head and the neckline and projecting that same distance from the breakout point. While this provides a useful objective, traders should also consider nearby support and resistance, higher timeframe structure, volatility, and the available risk-to-reward ratio before taking the trade. Both versions of the head and shoulders pattern are valuable because they reveal a clear shift in market behavior. In the standard pattern, buyers gradually lose momentum until sellers take control after the neckline breaks. In the inverse pattern, sellers progressively lose strength until buyers confirm a potential reversal by breaking above the neckline. Now that we have explored the head and shoulders formations, let us move on to 2 other classic reversal patterns, the double top and the double bottom. These formations often develop near the end of an established trend. A double top typically appears after an uptrend and may signal a bearish reversal, while a double bottom forms after a downtrend and may indicate that buyers are preparing to regain control. Let us begin with the double top. This pattern forms when price reaches a resistance area, pulls back, and then returns to approximately the same level, but fails to continue higher. Although the 2 highs do not need to be identical, they should form within the same general resistance area and create a recognizable structure. The first high shows that buyers were strong enough to push price into that region. After the pullback, they attempt another rally, but this second attempt fails to generate a decisive breakout. As buying momentum weakens, sellers become more active around the resistance level, suggesting that control may gradually be shifting. Now, observe the Bitcoin against the US dollar chart. The market begins in an uptrend before reaching a high point. Price then pulls back and rallies again toward the same resistance area. However, it fails to break convincingly above the previous high and starts moving lower once more. At this stage, the double top structure is visible, but the reversal has not yet been confirmed. Confirmation occurs only when price breaks below the support level formed between the 2 peaks, sometimes referred to as the neckline of the double top. Until that support is broken, the market may simply remain in consolidation or continue the original uptrend. Once price closes below it, sellers confirm that they have broken an important part of the bullish structure, increasing the probability of further downside. Sometimes, instead of forming only 2 peaks, price may test the same resistance area 3 or more times. These formations are often referred to as equal highs or multiple tops. Although repeated failures to break resistance may suggest weakening buying pressure, they do not guarantee a reversal. Traders should still wait for a confirmed break below support before acting on the pattern. Now, let us examine the double bottom, which works in the opposite direction. This formation usually develops near the end of a downtrend and indicates that selling pressure may be weakening. Price falls into a support area, bounces, and then returns to approximately the same level. During the second test, sellers fail to produce a meaningful lower low, suggesting that buyers are beginning to defend the area. Looking again at the Bitcoin against the US dollar chart, price creates the first low before bouncing. It then declines once more, but fails to break convincingly below the previous low, forming the second trough. Just as with the double top, the visual structure alone is not enough. The reversal is confirmed only when price breaks above the resistance level formed between the two lows. Equal lows or repeated tests of support can also appear before a reversal. These structures indicate that sellers have made several unsuccessful attempts to continue lower. However, repeated tests can weaken support, so traders should not assume that every series of equal lows will result in a bullish reversal. The strongest confirmation still comes from a decisive break above resistance. To identify either pattern, first look for 2 recognizable peaks in a double top, or 2 recognizable troughs in a double bottom, separated by a clear pullback or bounce. Then identify the confirmation level. For a double top, it is the support between the peaks. For a double bottom, it is the resistance between the troughs. The pattern becomes valid only after price breaks through that level. Until then, what appears to be a reversal may simply become another continuation pattern. Recognizing a reversal pattern is only the beginning. Before entering, traders must define the invalidation level, place the stop loss according to market structure, and avoid allowing a small, controlled loss to grow through hesitation, hope, or emotional attachment. A stop loss is not designed to predict the exact reversal point. Its purpose is to protect the account when the market proves the original analysis wrong. Reversal patterns also have important limitations. False breakouts are common, especially during volatile or choppy conditions, and economic events can quickly override a technically valid setup. Waiting for confirmation may reduce premature entries, but it can also lead to entering after much of the move has already occurred. For that reason, every confirmed pattern must still offer a logical stop, sufficient target distance, and an acceptable risk-to-reward ratio. Common mistakes include relying on the visual pattern alone, entering before confirmation, anticipating incomplete formations, ignoring the quality of the breakout, and chasing price after the move has already extended. Traders should evaluate higher timeframe structure, support and resistance, volatility, volume, and relevant economic events. Clear rules should define whether confirmation requires a candle close, a retest, momentum, volume expansion, or alignment with the broader trend. The head and shoulders, inverse head and shoulders, double top, and double bottom can all reveal changes in the balance between buyers and sellers, but no chart pattern or trading system can guarantee success. Trading should be approached as a series of risk-managed opportunities, not a search for certainty. Long-term consistency comes from combining these patterns with market context, disciplined execution, proper position sizing, and a clear plan for managing risk. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.